All right. Today is Thursday, January 13th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. And what a day we had today. Absolute brutality in the stock market today. We're going to talk about all of what happened. But before we do that, let's go right ahead in our macro discussion. And here it is. In focus tonight. A false sense of security, swiping those credit cards up and down, up and down, up and down. But let's start with the background. As you might be aware by now, we have an insane, out of control inflation out there. Prices are going higher across the board, be it food, gas, rent, goods, services, cars, airfare. Everything is moving higher. And today we got another piece of data from the PPI, the Producer Price Index. Year over year in December, wholesale prices for producers went higher by almost 10%. Once again, 10%. And I hate to bore the regular viewers of this program with this, but we have new viewers all the time. And I have to go over what is the real reason behind this inflation, because yesterday I was watching the evening news and none of these reports that I watched mentioned the word the Federal Reserve. None. So what is the real reason behind this inflation? The answer is the cocaine. What is the cocaine, you might ask? It is the trillions and trillions and trillions of dollars of liquidity, fake money, funny money, printed out of thin air by the Federal Reserve to respond to the so-called emergency. They cannot let any emergency go to waste. They printed trillions of dollars out of thin air, racking up trillions of dollars on the public debt of this country. Those trillions of dollars have to chase assets all over the place. The majority of these trillions land on the pockets of corporations, the rich, and institutionals. They chase assets, and therefore you're seeing the stock market all-time highs to the moon, bonds to the moon, real estate to the moon, commodities to the moon, NFTs to the moon, tulips to the moon, fake stuff from the metaverse to the moon, farts in a jar to the moon. Everything is moving higher because all of these trillions are chasing few assets. Some of these trillions land in the pockets of us, the consumer, be it in the form of stimmies or otherwise. We, the consumer, are also using this money to chase few goods. When you have everybody chasing few goods at the same time, you're going to have shortages, lack of supply, and this is causing inflation to move higher. And now it's becoming a game of expectations. Our expectations for inflation are moving higher and higher and higher. And therefore, we're buying now because we're expecting prices to be higher in the long run. And with this mentality, we're stampeding once again to chase very few assets, very few goods and services, and this is pushing inflation higher and higher and higher. It becomes a self-fulfilling prophecy. If all of us are anticipating prices to go higher in the next few weeks, then we're all going to stampede to take advantage of lower prices right now, and this pushes prices higher next week and the week after if the behavior continues. And therefore, you can go back hundreds of years to study inflation. Inflation has always been a monetary phenomenon. What does that mean? The source of inflation is always the Federal Reserve. Anything else is secondary to that, be it the virus, be it China, be it supply chain, be it asteroids hitting the planet, doesn't matter to me. If the Fed overstimulates a hot economy that doesn't need stimulation to begin with excess liquidity, you're going to have inflation. Period. Full stop. And therefore, to tame this inflation, the out-of-control inflation, the Fed is acting after they've been telling us it's going to be transitory. And in this channel, we said over and over and over again, it's not going to be transitory. There is no such thing as transitory inflation. And now the Fed is playing catch-up. They're already behind the curve by a lot. And to play catch-up, they're going to have to be really aggressive in raising interest rates higher. Raising interest rates higher is the equivalent of monetary tightening. When you tighten the borrowing limits by raising interest rates higher, that reduces demand in the economy and it cools down this inflation. It's going to take a while, and the Fed might be more aggressive than they ever thought. And by being aggressive, they might crash the economy, the stock market, and induce a recession. That is the risk to tame inflation. But the point from all of this story is interest rates will move higher. Keep that in mind. Now, when we talk about the PPI that we got today, a lot of observers were celebrating in the morning, shall we say, that perhaps the month-over-month reading in the Producer Price Index is cooling down, and therefore this could be the peak of inflation. Watch out here. Your assumptions are wrong. Costs are going up at an accelerating pace place even when stripping out food and energy. While today's PPI data came in a bit lighter than expected on an overall basis, listen to this. Core inflation for producers climbed more than expected to 8.3%. And this is even after stripping away food and energy. How about we strip away oxygen too? And this tweet is from Bloomberg's Lisa Abramowitz. She also added, and this is important, perhaps you can understand the urgency of the Fed's action to catch up by raising interest rates significantly higher. One of the most important charts from this week's data consists of real wages, which are deeply negative as wages fail to keep up with inflation. Workers are demanding higher pay and will continue to do so as they see the spending power of their paychecks decline. What does that mean? It means, for the majority of us, our real wages went down when you factor in inflation. You might be partying, my boss gave me 5% raise. You genius. Inflation is at 7% minimum. And this is the cooked, watered down number from the CPI, the Consumer Price Index. Let's take that at face value. If you got a raise of 5%, you factor in inflation, you're down 2%. Your purchasing power is down. And this is, of course, is becoming more noticeable by us, and it's causing a backlash, a political backlash. We, well, not you and I, because we're more informed, but the majority of the population is going to blame inflation on whoever is in the White House right now, and it happens to be Joe Biden. Don't get me wrong, the Biden administration policies are absolutely horrendous, and they're causing more inflation, yet the origin any inflation is always the monetary policy, meaning the Federal Reserve, the reckless policy of the Fed. But this political backlash is pushing the administration to add pressure on the Federal Reserve to enact policies to control inflation, once again meaning higher interest rates. Things are getting so bad and costly out there that the average American says they need to earn $128,000 to feel financially okay. And I say, really? $128,000 in California? That's nothing. You need at least another 50 grand on top of that, because $128,000 ain't gonna get you anything in California. Not even a garage or a guest house, maybe an Amazon box in the middle of the street. That'll be your house for $128,000. Just grab the box, put it on the top of your head, boom, you got a house. And this inflation is not cooling down anytime soon. Look at the shipping rates from Shanghai to New York, to Italy, to the Netherlands, to LA. They're all surging higher. Now, let me ask you a question here, because the media says the source of inflation is the supply chain, the shortage of supply, the virus, the thing. Let me ask you this. Did COVID, the thing, somehow sink ships across the globe so we have a shortage of ships all of a sudden? Did ships magically disappear because of the pandemic? Are they quarantining right now? Are they socially distancing right now? Of course not. What we have is an insane level of demand that is overwhelming all of these ships. In reaction to that, shipping rates are moving higher. What is causing the insane demand, out of control demand in the economy? The answer is the cocaine. And now the Fed all of a sudden says, we're seeing signs of slowing optimism in the economy. Oh, you think? With this inflation? And of course, this is the same organization that is supposed to be concentrating on inflation. Their mandate is price stability, meaning controlling inflation, and full employment. They failed on both. We have inflation out of control, and we have yet to reach full employment, whatever that means. And by the way, all of these job gains that we got, they're not sustainable. The moment the market goes down or the economy starts to sour a little bit, all of these jobs will be gone. They will be gone so fast, you're not going to even realize what just happened. But rest assured, the Fed got you back. The Fed is concentrating on climate change. What are they going to do about climate change? How about stopping the printing machine? Because that's adding a lot to global warming. The heat from the machine, all that printing, maybe that's how. Their other mandate is diversity now. The Fed is so proud of their latest achievement. Here it is. White men. Does that include the Pillsbury Doughboy? Because regardless, he'll do a better job than any of these Fed zombies. But anyways, white men are in the minority on the boards of all 12 U.S. Federal Reserve banks for the first time as the Fed takes strides in diversity. So I guess if I get screwed by a black man or a white woman, that'll make me feel a little better, right? I got robbed, I got screwed, but at least it happened by a woman. These are the priorities of the Federal Reserve right now. Are you really surprised that inflation is getting out of control, that the Fed failed to control inflation? I'm not. But here's the bottom line, folks. Interest rates will go higher. With that understanding in mind, now listen to this. You might hear in the media that it's okay for the Fed to raise interest rates higher. The stock market is going to be fine. The economy is going to be fine. Look at corporate earnings. Look at the consumer. They're so strong and powerful. They continue to spend. Corporate earnings are rising higher. Stop worrying about higher interest rates. And here's what I say to that. There are 3 stages of consumer spending. Number 1, the stimmies. They're going to spend the stimmies, and those stimmies, trillions and trillions of dollars, will translate into higher corporate profits. Well, guess what? We've already exhausted the stimmies. We're done with the stimmies now. Stage number 1, gone. Stage number 2 is exhausting savings. Well, guess what's going on right now? Household savings rate is plummeting below the pre-pandemic reading. So those savings are now gone. Poof. What is stage number 3? The answer is swiping those credit cards up and down, up and down, up and down. And this is happening right now. Now, what happens after that? The answer is the whole game comes down crashing. Because who's going to spot those corporate earnings and profits when the consumer is out of cash? You see, in 2020, in the beginning of 2021, when the stimmies were rolling, a lot of us used the stimmies to pay down credit card debt. And therefore, the percentage change of the U.S. household debt for credit cards went down by almost 14%. Mortgages went higher by 8%. Any other type of debt went higher by 6%. Auto loans went higher by 6%. Student loans higher by 2.5%. So far, so good, because the stimmies were here, savings were higher. Fast forward to today, stage number 3. The headline reads, consumer debt in the U.S. surges by a record $40 billion. Look at this. This is a recipe for disaster. We're racking more debt faster than ever. Yet the Fed and the experts say we're never going to face an economic disaster like we had back in 07, 09. That's never going to happen because we now have higher credit ratings, and therefore we're not seeing the reckless lending and borrowing activities that we got back then. Well, think again, because consumers are racking credit card debt and other sorts of debt faster than ever before. During the holiday season, sales jumped by 8.5%, MasterCard says, as shoppers shrug off higher prices. They're shaking it off like Taylor Swift. Higher prices, no problem. We got the cash. And if we don't have the cash, we're using those credit cards. We're going to pay them later, no problem, because we got our jobs in the bag. We'll see. But here it is. Holiday shopping fuels the return of credit card debt. After paying off a record $83 billion in credit card debt in 2020, Americans are on track to end this year back in the red. Yay! And they say credit card balances are expected to continue to rise in 2022. Overall, credit card balances rose by $17 billion in the third quarter of 2021 alone. By the end of the year, Americans are now on track to end up with $70 billion more in credit card debt, according to a projection by personal finance site Wallet Hub. The average household's credit balance is now $8,006, according once again to Wallet Hub. That's not bad, right? Hold your horses, it's gonna get worse. Balances are expected to continue to rise in 2022, ending the first quarter as much as 10% higher than a year ago, as more consumers apply for credit and increase their spending, according to a forecast by TransUnion. Usually, credit balances decline in the first month of the year as borrowers pay off their holiday spending. By the fourth quarter of 2022, total balances are expected to reach $805.7 billion. TransUnion found the highest level since the thing began. However, credit card debt is particularly hard to pay down. Oh, really? Especially with average annual percentage rate at more than 16%. Eric Ellerman, Senior Vice President of Public Policy and Legal Affairs for the Consumer Data Industry Association, advises shoppers to be thoughtful about any new debt obligations they take on this year. When consumers get in over their head, there are some obvious implications, quote unquote. He also added, quote, the credit scores could go down, and that could increase the cost of future borrowing. end quote. On top of that, he said you should go into every purchase with an eye on the future. Mr. Elman, forget about it. These zombies are begging to get slaughtered. You really think the consumer is aware of any of that? Of course not. The consumer is not aware of the credit card rate that they're paying. 40% of Americans with credit card debt don't know their interest rate. Survey shows the average credit card rate is 16.3%, according to Bankrate. Mind you, 16.3%, while the federal funds rates are pretty much at zero. So for Wall Street, they can borrow money with zero interest rates. You and I gotta pay a minimum of 16%. With the Federal Reserve planning to raise interest rates this year, credit card rates will be more like an average 17% by the end of the year. Roseman predicts. Make that 25% by the end of the year, maybe 50. Yet those who carry balances tend to have even higher rates, perhaps due to lower credit scores, he said. Accounts assessed interest had an average 17.13% interest rate in the third quarter of 2021, according to the Fed. At the higher rate, if you made minimum payments toward the average credit card balance, which is $5,525, according to Experian, it would take you 16 years to pay off the debt. You would owe more than $6,500 in interest. But is that stopping Americans from spending? Of course not. Hello, interest rates are going to go higher. All of that debt you're racking, you're going to pay more for it. Your purchasing power is going to go down. You're not going to spend any more, which means corporate profits are going to go down, which means that the economy is going to dip into a recession, yada, yada, yada. And who's to say by that point inflation is going to go away or not? Because we've seen something called stagflation before. When the economy stagnates, when spending stagnates, yet prices continue to stay higher. It's called stagflation. 1 in 3 Americans overspend during the holidays, boosting credit card balance. Uh-oh. Americans went all out this holiday, spending much more than the year before, and in some cases more than they could afford. What a bunch of geniuses. Roughly 1/3 of shoppers went more than $1,000 into debt, according to a report. And it gets worse. More Americans took on holiday debt this season, owing an average of $1,249. Amid rising prices, American families fall deeper in debt, and here it is. I know you said, hey, $1,000, $1,200, $8,000, that's not a big deal, but here it is. From credit cards to car loans, the average family now owes $155,622. Once again, the Fed says there is no risk this time around because we're not seeing reckless spending and reckless borrowing and lending. Think again. With these interest rates moving higher and the average family is owing over $155,000, this is a recipe for an upcoming epic disaster. The Gen Zers, they haven't even started life yet and they already owe almost $10,000. Millennials, they owe about $78,000. Gen Xers owe about $136,000. Boomers at around $100,000. The silent generation, they're still alive, they owe about $41,000. When it comes to credit cards, Gen Xers have the highest credit card balance with about $8,200. When it comes to auto loans, Gen Xers, once again, at number 1, with the highest auto loan balance of $21,570. How about mortgage loans? Once again, at number 1, capturing the gold medal, Gen Xers. You guys are doing a good job by owing an average balance of $238,344. Millennials are not far behind. When it comes to personal loans, boomers at number 1 with the highest balance of $19,253. And then we have student loans. Once again, Gen Xers, you guys are beyond have the highest amount of student loan debt, an average of $39,981, make that $40,000. When it comes to home equity lines of credit, once again, Gen Xers at number 1 with almost $49,000 owed. Oh boy. The headline reads, Americans have never been in so much debt. What could go wrong, right? The roaring 20s, they say. Wait till the roaring 20s bite you in the ass. And of course, now that interest rates are moving higher, the criminals, the banks, who've been making a ton ton of money when interest rates were down via the criminal activity of charging us fees, overdraft fees, minimum balance fees, you forgot to check your account fees, you forgot to scratch your nut fees over and over and over and over again. And now that the Fed is about to raise interest rates, they don't have to do that anymore. So they're saying, you know what? We're going to drop the non-sufficient funds charges, the overdraft fees. Oh, how generous of them. Because now they can borrow money at a cheaper price and they can lend that money out at a higher rate, which is supposed to be the business model of banks. And as you can see, bank loans are rebounding higher. So the Fed says, oh, forget about '07, '09. That's not going to happen again because we don't have the same kind of risk that we had before. Think again. And by the way, this is a worldwide phenomenon. Even in the UK, the British consumer is also swiping those credit cards up and down, up and down, up and down. And you wonder why we have inflation in the United Kingdom. But you know where we're not having inflation? Japan. You know why? Because the Japanese, they're not spending. The month-over-month spending is down in November. So yes, the Bank of Japan is printing a lot of coke out of thin air, but the Japanese are saving the coke. They're not snorting it right away like we do here in this country. And therefore, Japan remains in deflation. But Japan is not immune from inflation either because they are a net importer of oil and energy. When energy prices move higher, the Japanese consumer is going to have to pay more for gas and transportation costs. The good news is they've been saving so much coke for a long time, the average Japanese consumer is not going to face an inflation problem because they're ready. The question is, are you ready? A lot of you ask me, what's up with the FUD, bro? You keep saying that the economy is going to crash, the stock market is going to crash. So what do we do? How come you never tell us what we should do? How about you start by this? Pay your damn credit card. And oh, by the way, make sure that you have at least 10 months worth of savings. You got to calculate your mortgage payment, your auto loan payment, your rent, your groceries, your utility bills, and come up with a number. Whatever that number is, multiply that number by 10, and you're going to have that saved in your account. Because God forbid the economy turns sour, you end up losing your job, you're going to be well off. A, you don't have credit card debt. B, you're already prepared. You have at least a 10-month worth of savings in your account. You can fall on that cushion if things turn sour. But if you're racking credit card debt, and you're spending all of your income on cryptos and tulips, what happens if that crashes and now you owe credit card debt? And oh, by the way, interest rates are going to move higher. And on top of that, you lost your job. What are you going to do? And the most dangerous kind of debt from consumers is margin debt. Margin debt is rising. It is becoming a risk for stocks. What are they talking about here? The rising amount of debt is concerning, but more worrisome is the percentage of stock market's value that the debt represents. Margin debt is currently 2.4% of the S&P 500's aggregate market capitalization of $38 trillion. Just before the pandemic, it was at roughly 2%. To be sure, the current level of margin debt relative to the stock market's value is still below its high, the 3.5% that it reached around the time of the 2008-2009 financial crisis. The lowest point since the mid-1990s was below 2%. In any event, the combination of rising margin debt and slipping stock prices augments the risk to the market. When the value of the shares a trader purchases on margin falls to a certain point, the broker that lent the money demands that the trader deposit additional cash in the account. Either the trader has the money available or, listen to this, he or she must sell stock to raise the cash. So if you're buying on margin, YOLOing stocks, and then they start to take the trip to the south, what's going to happen is the bank is going to say either you add a deposit to cover your losses because you borrowed on margin, or we're going to have to sell your other stocks to compensate for your losses. Here's the risk to the market. Let's say the Fed raises interest rates higher. One thing will happen is your margin debt rate will move higher. Number one. Number two, stocks will go down. We're going to have a revaluation of the stock market. When interest rates move higher, you got to trim down those valuations, meaning stocks will go down either way. Yet the normal reaction to higher interest rates in the market could be a correction of about 25%, let's say 35%. That is not a big deal. We've seen those before. But if margin calls start to hit and your broker, your bank, whoever lent you the money, exercise those margin calls by dumping your other stocks to compensate for your losses, oh boy. Because we will see a tsunami of selling that could exacerbate a crash of 25 to 35% and morph that into a 50 if not 75% crash. This is the real risk to the market here, and people are becoming so irresponsible, living beyond their means, racking up credit card debt, gambling on stocks and cryptos, tulips, meme stocks, and other fake assets via margin. Folks, this is a recipe for an upcoming epic disaster. Look at this, for example. The margin debt is around $1 trillion. But we look at the 15-month rate of change in margin debt. Every time we have a reading above 50, it means we have excessive speculation in the market. When you see the 15-month rate of change rolling over, it almost always precedes a crash in the stock market, specifically when it breaches the reading of 48, and this is exactly what's happening right now. But rest assured, you don't have to be scared by all of the data and the facts I just shared with you, because you have an ally who always looks at the glass half full, and that is the criminal organization of J.P. Morgan. The criminals at J.P. Morgan say, come on, man, the global stock market party is far from over. Don't get scared, the water is warm. Take your shoes off. Walk slowly. We'll hold your hand and walk you down to the warm waters, and then we're going to feed you to the alligators. Because while the criminals at JP Morgan say the party's far from over, their boss, the top dog, Jamie Dimon, says that he expects more than 4 rate increases in 2022 alone. Is this bullish or bearish for the market? It is bearish. He also expects a lot of market volatility, and Dimon added, if we are lucky, the Fed can engineer a soft landing, quote unquote. It sounds like Mr. Dimon is betting for higher interest rates and betting that the market will crash. Meanwhile, his so-called strategists say the party is not over. Who do you believe? Anyhow, folks, we're moving on to cover the market information, starting with the performance of the indices, and here we go. The Dow Industrial Average down by 176.70 points or decline of 0.49%. The Nasdaq taking it on the chin, down 381.58 points or a decline of almost 2.5%. The S&P 500 also closing in the red, down by 67.32 points or a decline of 1.42%. What about the sector's performance today? Not so hot so. We only have defensives and utilities closing in the green. Not by a lot, by the way. So we're not giving away any medals today. But we can shame some names because the laggards of the day led by technology, cyclicals, and communication services. What about the advance to decline ratios? NYSE 52% advancing versus 46% declining. The Nasdaq 31% advancing versus 65% declining. Believe it or not, the NYSE had a positive spread today, which means that we still have certain pockets of this market outperforming. You gotta be in the right ones and avoid the wrong ones. Moving on to futures. What's going on here? A bloodbath across the board. Not as bad as the stock market, but still, we have crude oil down. Both the WTI and Brent. WTI down over 1%, Brent almost 1%, gas down. Heating oil flat, and natural gas prices down big, almost 11%, erasing pretty much all of the gains from yesterday. Yet bear in mind that natural gas prices started the year at around 3.5. They're now trading above 4, and we're seeing insane volatility in the natural gas market, and this is just getting started here. We have the weather on one front, inflation on the other, then we have the geopolitical tensions between Russia, Ukraine, and therefore I'm expecting the volatility in natural gas prices to continue. What about softs? What's going on here? The gains in lumber continue. Lumber adding over 3% gains today alone. Soon enough, we're going to reach the previous all-time highs. Likewise, we have massive gains for OJ, scoring almost 5% gains today alone. Likewise, we have gains for cocoa, gaining over 2.25% today. Yet we have pullbacks led by coffee, sugar, and cotton. What about metals? Down across the board, even though the dollar and yields were down on the 10-year. Gold down, silver down, platinum down, copper down, palladium down, everything is down. We're seeing de-risking across all assets, not just stocks. What about meats? We have sizable gains for feeder cattle futures, gaining over 1% today, yet modest gains for live cattle futures. On the other hand, we have losses for lean hogs, down by about 1% today. Grains, bloodbath, everything is down, led by oats, corn, soybean meal, wheat, soybean oil, soybeans, they're all down. Yet we have modest gains for rough rice and canola. And here is some commodities news for you. We'll continue to watch the tensions between Russia, Ukraine, and the talks that are going on between the US and Russia. It appears for now that we're not reaching any agreement with Putin. And therefore, we're seeing these exercises and drills. I believe that we're going to have a surprise invasion of Ukraine. I think Putin is bluffing to secure a deal. If that deal is not secured, he's going to invade. It is the right time to invade after all. Can the US, led by Biden, and European allies do anything after all? Of course not. They're busy with inflation and economic woes. They might let Ukraine be collateral damage after all, and that could produce severe sanctions against Russia. They will respond by crushing the supply of oil and gas, and inflation will move higher. This situation is becoming increasingly alarming, and we have to keep an eye on it. But today I want to talk about metals, specifically nickel. Look at the performance of metals, be it tin, be it copper, nickel, aluminum, zinc, lead, they're all surging higher. When we talk about the proliferation of EVs, we have to talk about lithium, nickel, aluminum, all of these components involved in manufacturing EVs, specifically batteries. We talked about lithium a few episodes ago, lithium prices to the moon. So are zinc prices also moving higher as the inventory becomes scarce. But we have a massive shortage of supply in nickel, one of the most important components in EV batteries. Nickel has already surpassed the highs from 2014. And as you can see, inventories nowhere to be found, and this is pushing nickel prices to rocket higher. And this demand will continue as we see governments and manufacturers alike putting more effort into producing more electric vehicles. Lithium is going to move higher, nickel will move higher, cobalt will move higher. All of these are the new oil. Even in Shanghai, Chinese nickel prices are also moving out of whack. You get the picture. Why do I bring up the prices of lithium and nickel? Number one, you can invest in those. There is an EV war. Every manufacturer and supplier is stampeding to secure resources of nickel or lithium. When they engage in a price war, you don't want to invest in these companies, EV manufacturers. They lose their luster. You want to buy the bullet stocks. The bullet stocks are the miners. But another point is to illustrate the fact that inflation is going to be with us for a long time. As these prices move higher, as manufacturers move away from combustion engines to electric vehicles, they're going to have to pay the higher prices of lithium, nickel, zinc, cobalt, and all of these other resources. What does that mean? At the end of the day, the average price for a vehicle will move significantly higher. When all of these cars become EVs and you have no other choice, the average price for a vehicle will move significantly higher. What does that mean? Inflation will be with us for a long time. What a genius idea, by the way. Let's be green and change everything to EVs. Well, you're going to push the prices of cars significantly higher. Meanwhile, the median income and wages are not catching up with inflation. Another genius idea. Rather than having a gradual transition from fossil fuels to so-called green energy, which are not that green, by the way, we're moving rapidly, and this move will result in more expensive cars. Tesla is also scrambling. They're ahead of the game, so they have the advantage in the supply chain, and Tesla just struck a deal to ensure ample supply of nickel. Tesla agreed to purchase nickel supplies from miner Talon Metals, as an unexpected surge in demand spurs automakers to secure access to battery metals and other electric car parts. And in this deal, Tesla is committing to buy at least 75,000 metric tons of nickel concentrates. Now, is this good for the environment at all? Because the Tesla culties and the green energy pushers keep saying, we gotta move from fossil fuels to save the planet, save the planet, save the planet. So we gotta mine more lithium, nickel, cobalt, zinc, and all of these mining activities couldn't be any more harmful to the environment. In the case of nickel, take a look at this report.
It's been called one of the most beautiful places on Earth. Palawan, a stunning tropical island in the Philippines, a diver's paradise, an ecological wonder. But 300 miles south of its pristine beaches, a giant swath of Palawan's rainforest was destroyed decades ago, making way for one of the world's largest nickel mines, Rio Tuba. And now the current majority owner, Nickel Asia, has an ambitious plan to expand into more of the rainforest, adding the equivalent of nearly 4,700 football fields to the mine.
You have filed paperwork to do so, is that right?
Yes, we've filed paperwork because I think we still have about 4 years to go with the current area.
Global demand for nickel is surging, expected to grow 10 times over the next decade, experts say.
The diversification of where nickel is mined is definitely underway. There's a significant amount of momentum towards different parts of Asia.
That's because nickel is increasingly used in the stuff that powers our lives. Things like tablets, the phones we use every day, But the biggest demand for nickel right now? It's the batteries in electric vehicles.
These are eye-popping numbers. EV sales are going to be surging over the rest of this decade.
It's a top priority for the president.
You're going to set a new pace for electric vehicles.
Leading the way, Tesla, now the nation's top seller of EVs and desperate for the resources to make their clean energy cars go. NBC News has tracked nickel mined from the Philippine rainforest via processing factories in Japan and on to Tesla in California. CEO Elon Musk saying last year,
any mining companies out there, please mine more nickel. Tesla will give you a giant contract for a long period of time if you mine nickel efficiently and in an environmentally sensitive way.
But when it comes to the rainforest, every tree counts in the battle against climate change. Once destroyed, restoration is difficult.
Moving on to the big casino, the options market. What's going on here? The hottest table by far, although the volume is down all in all. But here it is, Tesla, number one, with about 1.1 million contracts traded today. About 57% of those were calls. At number two, Apple, with about 1.1 million contracts traded today. About 59% of those were calls. And at number three, Ford, with a little over 1 million contracts today. About 73% of those were calls. The implied volatility in Ford is absolutely insane. I'm a shareholder of Ford, and I'm taking advantage of that by selling upside calls to raise cash. What about the unusual activities that took place in the options market today, starting with the ticker BYND, Beyond Meat? Here's a piece of news for you. Beyond Meat happens to be the most shorted stock in the Russell 1000. Does that ring a short squeeze anywhere? Perhaps. The name is trading 10 times the revenues. Not the worst valuation out there, but not reasonable either. Regardless, we have bets that this name will get squeezed, and therefore they're buying calls, the 75 calls, with the expiration date January 14th. This is for the expiration date tomorrow. They're betting the Beyond Meat, which by the way bucked the trend of the market today. It actually closed in the green. In this case, they're betting the Beyond Meat will add more gains by tomorrow's closing. Specifically, over 6% gains, because they paid about $40 a piece for these 75 bucks calls, all in all spending about $1.2 million. What about the ticker ROKU, Roku? Beaten down, but somebody's betting for a rebound by buying the 180 calls for the expiration date February 18th, with the expectations that the name could rebound higher by more than 7% by then. They paid about $12.50 a piece to enter this trade, all in all spending about $15 million. Big time. What about the trade for the ticker IWM, the Russell 2000? They're buying puts here, the 200 puts for the expiration date April 14th, with the expectations that the name could drop down by more than 6.5% by then. They paid about $5.80 a piece to enter this trade, all in all spending about $6 million. Now, what about the trade for the ticker QQQ, the NASDAQ? They're buying puts, the 350 puts for the expiration date April 14th, with the expectations that the name could drop down by more than 7% by then. They paid about $9 a piece to enter this trade, all in all spending about $7.7 million. What about the trade for the ticker KSS for calls? They're buying calls on calls, the 52.5 strike for the expiration date March 18th, with the expectations that the name could pop higher by more than 8%. They paid about $3 a piece to enter this trade, all in all spending about $2.3 million. Lastly, what about the trade for the ticker RSX for the Russian ETF? They're buying calls here, the 28 calls for the expiration date April 14th, with the expectations the RSX will pop higher by more than 10.5% by then. They paid about 85 cents a piece to enter this trade, all in all spending about $600,000. I don't know what they're betting on. Are they betting for a resolution between the US and Russia? Are they betting for an invasion? Who knows? But they're betting that the RSX will recover. Moving on to the heat map analysis. What's going on here? You want to avoid the northwestern side of the market. The high multiple names, the software names, they're getting clobbered. On the other hand, value is outperforming, even within technology. Not by a lot, but look at IBM, Micron, Dell, Lam Research, all closed in the green today. The high multiples are getting whacked. In biotech, Netflix, Roku, Zoom, Twilio, Snapchat down over 10% today. Wow. Roblox, Tesla down almost 7%. Chinese names also down big, yet value continues to outperform. Ford moving higher, Toyota moving higher, AT&T moving higher. Even in technology, we have Taiwan, TSM. This is getting short squeezed, so it is an exception for now. But you look at the reopening names, even industrials, Boeing, Caterpillar, Deere, all working. Financials, similar story. Defensives, the value names, they're moving higher. Take, for example, Kroger, the ticker KR, which I happen to own in my portfolio. I've been advocating for Kroger for a long time now. Even though we have a strike, a big one, the stock got hit big time earlier this week, but it recovered. The reason is Kroger is the kind of name that you want to own right now. In this tightening environment, in this inflationary environment, you want to be in these kind of names. Value, high cash flow, high dividend, and good valuations. Another one. We have Viacom moving higher. I'm playing Discovery. Doesn't matter which one you play, Discovery, Viacom, they're all value. I do like Discovery a little more than Viacom because Discovery has a better footprint in the streaming arena. Lastly, what about the heat map for the ETFs in the market? Nothing is working here, folks. Everything is down, even energy down, XOP down, healthcare down, tech down. It was a selling kind of day, not a buying kind of day. But the selling was discriminate against growth. Look at the contrast between growth and value and mid-cap. Believe it or not, value and mid-cap were down today, but these losses pale in comparison with the massive declines in growth. Growth getting hit really hard, even though the 10-year yield did not pop higher. Perhaps it is working some overbought technical conditions before it moves higher again. Regardless, the inflation reading that we got yesterday and the one we got today from the PPI, both of them affirm the Fed will raise interest rates. No doubt about it at all. And therefore, you got to avoid growth and stick to value. There is no guarantee that value will trade higher either, but you're better off hiding in value than growth. You're better off raising cash. Everybody shits on cash, but cash is still an option. Moving on to charts, starting with SPY, 30 minutes chart. What's going on here? We had the bear flag yesterday. The action was not good. Inflation came out higher. The 10-year yield did not decline tremendously, and I issued this tweet, by the way, yesterday. I said that I'm closing my rebound plays, the RKK, etc., booking these gains, and I'm looking for shorting opportunities, because my thesis was wrong. I was betting for a massive pop after the CPI if it comes out soft. It did not, and therefore I had to change strategies right away, closing those calls, booking gains, using some of those gains to buy puts. And this was the right call because the market traded down today. The SPY, no exception here. Starting the day with a gap higher, that was a bull trap, a gap and crap, and after that the SPY flushed down, closing at the lows of the day. Is this bullish or bearish? The answer is it is bearish. On top of that, the support of 466.5 was violated. This is yet another point for the bears. Now notice this, we're gonna get oversold again, but that's not gonna happen until the SPY reaches at least 461. You might ask, where is the support? Does it really matter? The market is flushing down. You have 461, yet I would not be surprised if the SPY flushes down all the way to 456.5. And here is a daily chart for the continuous contract for the SPY, the S&P 500. What's going on here? A flush down, a reversal candle, erasing at least 2 days worth of activities. And the chart is now trading below 4,657, which is the bull to bear advantage line. What does that mean? The bears have the advantage right now. We have negative divergences on both momentum indicators. The dumping today happened by larger than average volume. All of these are good signs for the bears. The bears are in charge right now. And the risk for this chart is, what if what we're seeing right now is a formation of an ABC pattern? We saw the A leg. Perhaps we've already formed the B leg, and we are now in the process of forming the C leg. And if that happens, we're going down to a minimum 4,549.5, if not below that, all the way down to 4,472. What about the Qs? 30 minutes chart. What's going on here? A similar story to the SPY. We had the bear flag, another gap and crap in the morning, and closing at the lows of the day, violating the support of 379. Is this bullish or bearish? The answer is clear. Now, at some point, we're going to get oversold, and that has to be corrected. But it's not happening right now. It could happen all the way down at 372, 369, so the bears are still in advantage here. What about the daily chart for the continuous contract for the Qs, the Nasdaq? A flush down, erasing at least 2 days worth of gains and closing below 15,500. Is this bullish or bearish? The answer is it is bearish. We have negative divergences on both the RSI and the MACD indicators. The selling is happening on higher than average volume. That makes the bears in complete charge here. Once again, what if this is an ABC pattern? We saw the A, we finished the B, and now we're forming the C. The C could take us down all the way to 15,000, if not even below that. Moving on to the IWM 30 minutes chart for the Russell 2000. What's going on here? This was my leading indicator in the morning because we saw the gap, the crap, the formation of the bear flag, another gap and crap in the morning, failing. Recapture 218 for support. That was my leading indicator that it's not just going to be the Russell 2000. It's going to happen in the SPY and the Qs too. What about the dollar, the Dixie? What's going on here from a daily chart perspective? We're well below 96 for now. The dollar is still not oversold. Perhaps we need to go down all the way to 93.75 for support. But again, if the selling continues, the process of selling is raising cash. Raising cash is good for the dollar, so don't be surprised if the dollar stages a comeback here. The activities today were confusing, no doubt about it. The dollar is down. Why are commodities down too? The 10-year yield is down. Why is the Nasdaq down too? This is a piece of the mystery, the puzzle. We're going to solve it in time. We haven't gotten all the pieces yet. Keyword, yet. But here's the daily chart for gold. What's going on here? While the market is down big, it appears that gold is indeed a safe haven after all, at least for today. It did not go down by much. And we're eyeing the three amigos at around 1,835. That is the resistance. If gold manages to break above that, then we're looking for the descending, sloping line of resistance. All in all, I remain bullish on gold. Here is the chart for the 10-year yield. It was down today. It retested 1.7 for support. We have yet to have a confirmation whether 1.7 is indeed solid support or not. In the meantime, what if this is an ABC pattern and the C leg will take us to the moon, perhaps all the way to 2%. But at the end of the day, folks, it doesn't matter what the 10-year yield is going to do. It could move higher, yet the yield curve overall starts to flatten. What does that mean? You have the short end of the yield curve all the way to the 2-year. Then you have the long end of the yield curve from the 10 to the 30, and in between, the belly of the curve. In a healthy economy, the 10-year yield should pay more than the 2. The 30 should pay more than the 10. You're holding a bond for 30 years, you naturally expect higher returns. This is not what we're seeing right now between the 30 and the 20. The 20 is paying almost as the 30, if not more. So we have an inversion in the yield curve between the 20 and the 30. Not concerning right now. But if the 10 starts to pay more than the 30, and then soon enough, the 2 starts to pay more than the 10, then we're going to have the inversion of the yield curve, where the shorter end pays more than the longer end. And every time the yield curve has inverted, it predicted an upcoming recession. It's always a spot-on indicator. So watch out for this. The 10-year could go higher, and the geniuses over at CNBC, Wall Street Journal, Bloomberg, could say, the 10-year is moving higher. It is predicting higher growth in the economy. On the other hand, the entire yield curve is actually flattening, if not inverting, and this is not a good sign for the economy. In essence, an inverted yield curve is another way for the bond market to say, Mr. Powell, if you raise interest rates, you're going to crash the economy. Now, what is Powell supposed to do with that? Perhaps crashing the economy is inevitable. Keep that in mind. How about a weekly chart for the TLT? What's going on here? It is retracing some of the losses from last week, but again, well below 149. The assumption for now, yields will move higher, the TLT will move down. If the TLT starts to move higher, watch how the 2-year yield is going to behave. If the 2-year moves higher and the TLT also moves higher, then we're going to get closer to that inversion, and it's going to be an ugly one, where the 2-year is going to pay more than the 10 in a rapid manner. If that happens, oh boy, it's not just a recession, it's bigger than that. Moving on to a 4-hour chart for the VIX, what's going on here? Notice the MACD indicator, which is a lagging indicator, by the way. We use the MACD as a confirmation. It crossed down, showing red impressions on the histogram, and that was the relief rally in the SPY. Now the MACD is showing green impressions on the histogram after curling higher again. And by the way, it closed above 20. All of these are bullish signs for the VIX, which means bearish signs for the SPY. And here's a daily chart for the VIX, by the way. What does this look like? It looks like a bull flag pattern, about to pop higher. It is already popping higher. And if this continues to play, then we will see a minimum reading of 25 from the VIX before it tops out. Moving on to a 4-hour chart for the VXN. This is the VIX for the Nasdaq. Now the MACD here dipped slightly, showing red impressions on the histogram briefly. And that came hand in hand with the bull trap in the Nasdaq that we saw yesterday. The Nasdaq moved higher, then forming a bear flag, and today it flushed down, hence the bull flag. But now the MACD is moving higher again, showing green impressions on the histogram, which means that we're not done with this round yet. We're not done with the pop in the VXN. What does that mean? We're not done with the dump in the NASDAQ. Moving on to Apple, 1 hour chart. What's going on here? We have the sloping line of support/resistance. If you're trading above it, it is support. If you're trading below it, it is resistance. And it played out perfectly if you look at the bubbles that I'm highlighting for you. It played out as support before. It played out as resistance before. Today, it played out as resistance, producing a rejection, as you can see in the last bubble. And then Apple closed pretty much at the lows of the day. Is this behavior bullish or bearish? The answer is it is bearish. Yet the good news for the bulls is the fact that Apple closed pretty much at 172.4. which happens to be support. Now, when we zoom out to a daily chart for Apple, the bulls are placing their bets that we have a double bottom, which is a bullish formation, and it is supposed to push Apple's stock higher, perhaps all the way back to 3 trillion, if not more. Now, the bears will counter and say, forget about the double bottom. What we have right now is a reverse ABC pattern, which will take us down all the way to revisit the channel. Moving on to an hourly chart of Tesla, the souffle. It gapped higher in the morning, and it traded above 1,090.5 for a while. And then, as the flush down happened in the NASDAQ, Tesla also aided on the chin, big time, down almost 7%, and now we're looking at 995 once again for support. But here's a thought for you. Let's remove all the lines here, all the indicators, all the markings, and switch to a line chart. Let me know what you see here, because what I see is a head and shoulder formation. I can also see a bear flag formation, and it is already playing out, which means that Tesla will go down below 900. We'll see. For now, what about tulips, BTC? What's going on here? It is trading above 42,000. That is the good news. The bad news is we're not seeing enthusiasm here. We're seeing risk off, and this is also including Bitcoin. This is a real test for Bitcoin and other cryptos. You claim that cryptos are, in this case Bitcoin, is an inflation hedge. It's a volatility hedge. It's a hedge against the market. If the market goes down, then you will find the safe haven in Bitcoin. Bitcoin has to deliver right now on these promises. If it is an inflation hedge, it should move higher. If it is a hedge against volatility in the equities market, then it should move higher. If it is a hedge against interest rates moving higher, then Bitcoin should move higher right now. It is not doing any of that, at least for now. The chart is in a bottoming process. It is asking for buyers. If the buyers don't show up in time, it's gonna flush down. And oh, by the way, remember the El Salvador with the president being the cool cat for a little while, tweeting all over the place, El Salvador bought the dip, yada, yada, yada. Well, now it appears that El Salvador is holding the bag. And I'll give this guy about 2 years tops before he gets assassinated. Anyhow, we're moving to AMC, the last chart of the day. And this is an hourly chart. What a beating, a massacre in AMC, down almost 9% for the day. And it violated 21 as support. This is bad, folks. It's hard to see a slaughter. And it's about to get worse, because I'm looking for support here, and I'm not finding any. I have to go to the monthly chart, and I'm seeing 20.36 as support. That could be the last hope for the apes, but after that, we're going back to the dumps. And by the way, your cult leader, you know, the silverback, well, he's stabbing you in the back, because Adam Aaron dumped about $42 million worth of AMC shares. And now he says, I'm done with the selling. I'm an ape now, once again. He's tweeting that I'm 67, and this was planned selling. I told you about it before. Now, I'm all in. This is baloney. This is garbage. You took advantage of the stupidity of retail investors. You buttered them with the memes, the cryptos, and Doge, and the free popcorn, and now they're left holding the bag while you cash in a 40 million plus worth of gains. This is a tragedy, folks. It is a tragedy of the stupidity of retail investors. It is a tragedy of how the sharks in Wall Street take advantage of the average folks, the mom and pop kind of investors who believe whatever garbage they read over at Reddit or whatever else. The last thing I would say about this, there was somebody looking out for retail investors, and that somebody's me, this channel. Go back and look at my previous videos that I made about AMC. I got attacked viciously by the apes. You're a boomer, you're a shorty, you're a hedgy, you're just jealous of our gains, bro. Yada, yada, yada. And now you know that there was somebody looking out for you, and you didn't listen. Anyhow, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have a lot, starting with retail sales in the morning, and then we have the import price index, the industrial production, the University of Michigan consumer sentiment index, we have business inventories, we have capacity utilization, and then we have the king of doves, Another zombie from the Fed, New York Fed President Williams. They're all hawks now. Williams is the only remaining dove right now. If he flips and becomes a hawk, oh boy. Now we have all of them. Williams, Kashkari, Mr., the rest of the zombies. All on the same boat. The hawkish boat. You know why? Because they got the order to become hawkish. That's why. Who gave the order? That's a different story. I'm not going to talk about it right now because I'd like to keep the channel and I'd like to remain alive. And with that, folks, we're done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.